Okay, let's conclude our discussion of common stock valuation, and we'll continue talking about some financial statement analysis, some ratios. This set refers to profitability ratios that measure how efficiently a company converts revenue into profits. So, Apple's net profit margin, for instance, is one of the highest in the tech sector, reflecting some strong pricing power and operational efficiency. You also could look at balance sheet information, where the return on equity is another kind of key ratio that indicates how efficiently management is using shareholders' funds to generate profits. The set on this slide represents those profitability ratios from the income statement. Gross profit tells us how well managers are controlling expenses of selling products and producing products. It is the um, sales minus its cost of goods sold, right, divided by sales. It talks about how we control those expenses. The operating profit margin tells us how they control all the expenses of running the firm. This then includes production, of course, but also includes things like marketing, research and development, the salaries of our fixed salaries of upper echelon, etc. And of course, the net profit margin is the bottom line that so many people talk about. As an investor, you are interested in trends. Does the company seem to have control of the gross profit? Do they seem to be able to control the cost of production? Can they improve on that? Or are they improving on those expenses? Likewise, we'd be interested in knowing about the other expenses of running the firm. Those two line items and their stability and or their downward growth, downward growth of expenses or upward growth of profitability are indicators that shareholders can be um, um, confident that the future will at least not be any worse than it is today. The next set of ratios look at the balance sheet context. Are we producing enough sales and profits for the assets that we've chosen? Now we have the return on equity here is the earnings after taxes divided by equity. And if we wanted to be a little bit more specific about the common shareholder, it would have earnings after taxes minus the preferred stock dividends. This tells us about the common equity piece. Since most companies don't have preferred stocks, we're usually just referred to as the return on equity number. But in case there is preferred stocks, you would like to be able to work that piece out to understand what the return is on the actual common shareholders. Again, as we can plug these numbers into a spreadsheet, we can see how the numbers have changed over time. This was last year, and this is this year, right? 2000x0, this is 2000x1. The company has decreased its gross profit margin. For some reason, we are now changing, right? Our ability to control our expenses decreased a little bit. We don't know why. We would want to explore that if we were in the company. Operating profit margin, though, has increased. So overall, our control of expenses of actually running the company has gotten better. Production's a little bit worse. Maybe we want to look at that if we're managing the company. But as an investor, we notice that there's really not that dramatic of a change. If I were an investor, I would want more than a couple of years to see if we had any really trends to look at. If you look at the return on equity, we see that there is a huge increase in the returns to shareholders. Likewise, even if you look at common equity, the increase has been substantial. So returns to the from a balance sheet perspective are increasing dramatically. The one area, again, if I was a manager, I would be concerned about the control of my production expenses. What is financial leverage? This ratio tells us about the company's financing strategy. Debt to equity shows tells us which sources of financing is bigger. Is it borrowing or is it equity? Debt to total assets shows us how much of our assets were purchased with debt. So more debt represents more financial risk. So if this example is from if the debt to total asset was 80.2%, that means that asset value can only decrease by 19.8 for assets can no longer cover the debt. This also said another way, creditors own essentially 80.2% of our assets. We only own 19.8%. So more debt may allow the company to grow and may provide some higher returns to shareholders, but it does bring additional risk that we may be concerned about. Coverage ratios measure the company's ability to service its debt. The TIE, or times interest earned ratio, tells us what? It's operating profit divided by the interest expense. If this number is greater than 1, it means we make more profit from operating the company than the interest that we owe for the money that we borrowed to purchase assets for the company. So this ratio tells us if the company appears to be able to handle the amount of debt they have. The greater the number, the greater the ability to make interest payments. A financial statement that is also of particular interest to it is something called the statement of cash flow. There's nothing more important to a business than cash. So a quick way that we can analyze or calculate cash is if you take net income, add depreciation, you end up with a quick and dirty kind of formula for cash flow. But more importantly, we'd like to know where the cash is going. The statement of cash flows breaks down our decision making into 3 categories, right? Cash comes from 3 things. It comes from operations. Can we create more cash that goes out the door from our primary business operations? What about investing? Are we creating any cash from investments? If we're selling more assets of plant and equipment, that type of stuff, then we're buying, this number will be positive. But in general, this number tends to be negative, since we will generally be buying more assets over time than selling plant and equipment. Financing just tells us some additional ways we get the money to help pay for these 2 things. So where can cash come from with financing? We're either borrowing money or we're selling stocks. So again, these are the 3 sources of financing. As an investor, you're very interested in making sure we can make cash from running our business. You're also interested in the investment strategy of the company. Is the company expanding or is the company contracting? And of course, we are interested in how much money ultimately flows to or from the various sources of debt and equity. So here we have an example of a statement of cash flows. And if we go down the line, we see here is the net cash flows provided by or used by operating activities. In this case, it is a negative number, 96.6, which means we have spent more money running our company than our company has taken in. This is a major issue for this company. We want to address this. If we're management, we want to address this as soon as possible. But as investors, this is going to concern us greatly. It's a major weakness of a company. If they can't make more money from their business, then they can't bring in more money from the business than they spend to do the business. Net cash flow provided by investing, again, is negative, 98.1, which means in general what? That we have bought lots of stuff. They have purchased lots of plant and equipment. Why are they doing that when they can't make money for running their business? These are all questions certainly a manager is going to be asking, but in addition, an investor is going to look at this and it's going to concern them somewhat. What about the net cash flow from investing? Again, it's negative $694. What's happening here? They've paid off some short-term debt, but they borrowed a lot of stock, or they have some long-term borrowing. But they've also repurchased a lot of stock. That's an outflow. So their cash flows are going out. This I would be asking the question, right? If the company can't make money up here, why are they repurchasing stock? So again, this is a very important question that can raise lots of eyebrows for a particular company. So now let's switch to talking about valuation. The valuation process is an attempt to predict the future outcome of the business's activities. This is where much of the uncertainty comes from. We're going to first look at something called the dividend discount model. It's ideal for companies that consistently pay dividends. So companies like Coca-Cola are prime examples. If we can estimate future dividend payments and discount them back, we can then calculate what we refer to as a company's intrinsic value. If that value is higher than the current price, then that stock may be undervalued. So where do the returns come from when you buy a stock? Only two things. This is the dividend yield, so you get a return when you get your dividends, of course. And then there is price changes. So the overall expected return of a stock is a combination of what we think the return is coming from dividends, what we think the increased stock price will be. So the expected return is what you think you'll receive if you buy the stock. If this expected return is greater than you desired, then you would want to purchase the stock. Now, one of the things a lot of these valuation models leave out is the impact of taxes and commissions. We are just looking for, is there value being created by the company? So our formula boils down to two versions. Really, we only need one version. The perpetuity model assumes that the growth rate of dividends is zero. So we really don't need this perpetuity model. But the constant growth model simplifies valuation into three things. What is the current dividend? D sub 0. We know what this is. We just received a check for the dividends of the company. What is the required return? This can be calculated by a formula from our risk analysis, the security market formula, which was the risk-free rate plus beta times the difference between the return on the stock market and the risk-free rate of return. Again, these three variables, the risk-free return, the average rate of return on the stock market, and beta, we know all of those variables. The third variable that we need to know, though, is the growth rate of future dividends. This is the hard part. We need to forecast what we will think will happen in the future to growth. This is where the money is made. So how can we look at the use of dividends and thinking about what they refer to as for finite periods? Again, to estimate dividends, we need to know the dividends for the next several years and find their present value. That's what boils down to what we just calculated, which is the constant dividend model. Another model that we can use, though, is what we refer to as the PE multiplier, but in general, just multiplier models. If you notice here, the price is the PE ratio multiplied by the earnings of the company. So if we take the PE ratio, multiply it by expected earnings, that gives us, again, a forecast of the price at time period N. So this PE ratio, again, it's the ratio of the stock price to earnings per share. We can compare that with other stocks. We can compare it to the industry. We can actually find published something referred to as the forward PE ratio. This is the same basic structure, except we're looking for future earnings per share in the denominator. This gives us a number that we expect to happen in the future. There's also something referred to as the Shiller PE ratio. This is adjusted by inflation. So there are several different versions of the PE ratio, but they all allow us to visualize the relationship between the stock price and the profitability of the firms. So here we see how we can utilize some of these numbers, if you will, or some of the ratios we can use in this analysis. Besides the PE ratio, we just talked about the forward PE ratio. So let's just take Amazon. On this day, the PE ratio is 66.9. What that means is investors are willing to pay $66.90 for every 1% or $1 of earnings. Moving forward, though, that number goes down. So we've analyzed here and said in the future, we don't think investors are going to want this or be willing to pay as much for their future earnings. Now, we can also look at price to sales. This just shows us in general the relationship in time between the stock price and the sales of the company. We can also make relationships between the stock price and book value. Again, how we can use these is if I can predict the book value, or if I can predict the sales, I can then unwind this formula and predict the price of the stock. Now, the PEG ratio is a little bit of a different number. That's the PE ratio divided by the earnings growth rate. This is going to give us an indication if the company has any growth potential. So the bigger this number, the greater the growth potential of that particular company is. And as you can see here, we have lots of different ranges here for our growth ratios. You notice that Ford has a very low PEG ratio, but our other companies like IBM, Merck, those companies have very high PE ratio or PEG ratio, implying they might be growth companies. That means they have potential for very high price appreciation. So what can we tell us about stock analysts, right? There are two kinds of analysts that we can be, right? There's two kinds of people in the world that work with investments. We have what are referred to as sell side analysts. These are the people that work for investment banks and they communicate to us, the public, their recommendations and forecasts. How they analyze the world is different than the buy side analysts. They work for institutional investors like mutual funds and pension funds. They're not for public consumption. So their analysis is slightly different. So, what is the difference between what we sometimes refer to as value investing and growth investing? Value investing seeks investment in firms that are undervalued. We try to find companies whose intrinsic value is less than what their price is. For some reason, right? We think that we I said that wrong. We want to try to find those companies whose price is too low from what we feel it's worth, right? So there are lots of companies who have lots of um, investment news, information, and for some reason we feel it's worth more than its current price. We think it is undervalued. Growth investing, though, is a different way of looking at the world. We're looking to find companies, regardless of what their price is, we're trying to find companies that have the potential for growth. So, value investors like Warren Buffett focus on companies that they view are undervalued relative to their intrinsic value. Their stock price is too low. They often invest in stable, dividend paying companies. Growth investors, though, seek companies with high growth potential, like Tesla and Zoom. If you understand these strategies, they can help you build a diversified portfolio tailored to your individual needs. So, in summary, value in common stock requires an understanding of the company's fundamentals, the ratios, the market dynamics. Whether you're evaluating a steady dividend payer or a high growth tech company, applying these models will help you make informed investment decisions. Just a word of caution, we have just scratched the surface. There's lots more experience, lots more knowledge you need to build before you make your own investment decisions. Thank you. Look forward to seeing you next time.